Welcome to Gurukul Live Lecture Series. I am Dr. Divya Verma Gakhar from Guru Gobind Singh Indraprasth University, and in the series of financial markets and institutions, today I am going to discuss about the topic related to stock market, how to invest in stock market. Friends, this topic of stock market investment is relevant to everyone. It's not only for those students who are studying commerce or economics or management or investments, but it is also relevant to anyone who has a knack of investments or who want to invest their money. Stock market is something which interests everyone because it is a market where we have studied, we have understood that people make a lot of money in this market, and a lot of newspapers. It's the barometer of economic growth of a country. So stock market is very important, very relevant. So today we are going to talk about various aspects of stock market. How do we invest in stock market? What are the factors we have to look at when we are investing in stock market? Some tips and some terminology I'm going to discuss about that how and when a beginner can start investing in this market. So why do we need to invest money? Every person is earning money, is saving money, wants to invest money because they have certain requirements, they have certain needs which they want to fulfill over years. So we have our present consumption needs and we have our future consumption needs. So whatever needs and wants and desires we have in our life, money is something that can fulfill it. And everything in this world is related to that how we can how we can earn money and how we can spend money on those luxuries of life which we want to enjoy. So the thing is that we are earning and we are saving money but what if that our money starts earning on itself? So that will be the best thing to happen to anyone. So that's what is the approach of everybody who is saving money. Whenever we go to a bank and save money, we buy a fixed deposit or we buy gold or we buy any other investment, we really feel that this money should multiply. So stock market is one area where we can invest our money and through which our money can multiply, but then this market is little risky. So we have to see that how this market is going to work and how you can be very safely how one can safely invest in this market. Now each one of us have some financial goals and investment objectives. These objectives can be short term or long term. Like some of us might want to save money for future educational requirement, for education of our children, for our children's marriage, for our own retirement, for buying a house, for going on a world trip, etc. These can be short term as well, like somebody wants to buy a car, wants to go on a holiday, or want to meet up some near future expenses. So in our life, we always have a vision and a plan for our investment objectives, and accordingly we want to grow our savings. Simply put, we simply want to put our money in our bank account. Now this is not going to make our money grow, but it will deplete as there is a normal level of inflation which exists in the economy. Now real returns are calculated as nominal returns, that means the interest which we are getting on our saving bank account or our fixed deposit minus the inflation rate. As we all understand that there is a little bit of inflation in the economy, and with inflation the purchasing power of money goes down. So with the purchasing power of money going down, so whatever we are going to get the rate of interest in the saving bank account or in a fixed deposit or any other financial instrument, we have to subtract it to understand that that is the real returns which we are getting after reduction in the purchasing power of money, that means the inflation effect. Money also gives us purchasing power to consume goods and services. It depends on the individual whether they wish to consume it in present or we want to postpone our consumption needs and want to invest in future. When a person earns money, he has two options, either to consume it today or save it for future consumption. If the person sacrifices to consume it today, then he or she will want to have more money tomorrow in order to have some payoff for the sacrifice which he is making. This prompts any person to invest the money left after today's consumption. Thus, investment is done in order to grow the existing amount of wealth to have a better purchasing power tomorrow. Now, we should not let our investments sit idle, as putting them in the right investment plan can make it earn better returns for us. We will reach our investment targets early if we allow our money to also work for us. Now, after understanding the importance of investment, let's see that what are the investment products that are available. Now, the investment products which are available are non-security investments, which can be also termed as non-marketable financial assets. For example, we can simply go to a bank and deposit our money in our saving bank account, which will give us very little, 3 to 4% of returns. Or we can deposit our money in a fixed deposit or a recurring deposit, or we can make some term deposits in a bank. We have various post office schemes in which one can invest money, and all of us understand these schemes. Every organization have their contributory provident funds. There is public provident fund where at the end of the year everybody invests money, saves money. There are government schemes like National Savings Certificates, Kisan Vikas Patras, and then there are insurance policies which all of us buy. Now, these are non-marketable financial assets. So, if somebody buy these assets, so it's for these are very safe assets. There is no risk involved, and these are very easy to invest avenues. And most of these are available with bank or post office schemes. And these products are generally carrying lowest level of risk of all instruments that are available. And generally, as a conservative society, we understand that these are the ways how we can easily save our money, where there will be very little risk of any loss of value of our money. But we also have to understand that the returns which we get on these instruments, which I have just talked about, they give very low returns. These returns in a saving bank account, you get just 3 to 4%. In a fixed deposit, you get between 6 to 7%, or in a public provident fund or any other investment scheme of government, we get, just because they are risk free, we get 6 to 8 to 9% in present times. Now, talking about what other ways of investments are there, we can also invest our money in real assets. Now, what are real assets? Real assets are the actual assets which we want to possess, like real estate. We can invest money in a residential house, we can buy a commercial property, we can buy agricultural land, we can buy suburban land, or a big house. Then we can make investment in precious objects like gold, silver, precious stones, art objects, or antiques. Now, investment in real assets is most desirable investment of everybody, and one dream house, a big car, everybody wants to have. But the amount of money required for investment in these type of real assets is really huge. So, not all investors have that amount of money all the time. And also, the liquidity of these assets is comparatively low than other investments. So, one does not sell and purchase real assets very frequently. The real asset investment can also depreciate. For example, if you buy a building, if you buy a flat or an office building, or maybe you buy gold jewelry which you are going to wear, so then the value can reduce and deplete over time. Although the basic assets like land and gold bars, they are always going to appreciate. Third type of investment alternatives are marketable financial assets, or are those securities which are marketable in nature. These includes investment in equity shares, preference shares, bonds or debentures, convertible securities, hybrid securities, derivative products, money market instruments, mutual funds, and ETFs. Now, these marketable financial assets is the one where we can get very high returns as an investor, and nowadays these assets are becoming very popular. But the level of riskiness of these instruments is from medium to high risk. For example, for mutual fund and ETFs, the risk is medium. But talking about equity investments, derivative investments, and preference share investment, the risk is really high. Now, accordingly, these instruments offer medium to high returns also. So, mutual fund and ETFs will give medium returns to an investor, and equity shares or investment in preference shares or derivative market can give very high returns, or give the highest return in the market, because the risk is also the highest. The liquidity of these instruments is very high, as the stock exchanges have developed mechanism for quick buying and selling of these securities. The regulators have worked really hard to change the image of stock market investment and have tried to generate faith of investors in the financial market as compared to the pre-liberalization era. Now, these instruments can offer returns more than fixed deposit returns and can match up to or go higher than index returns of the market. For example, one can earn return in good times, one can earn returns up from 15 to 20% in the stock market. Now, let's talk about that. What is the right age of investment? When should we start investing? Is there a right age? If you ask me, I would say that right age for investment would be as soon as you want to invest, because you can start investing your money as soon as you understand what is money and how money can be relevant for you in case you have certain investment objectives which you have set. So there's no right age. From a young age of being a child, one can start investment for the children. And if you are a student, let's say you are a commerce graduate, or you are you're a BCom student, or a bachelor level student, or class 11, 12 student, or you are a master's student, then I think all of you get pocket money, and one can start investing little bit of money in the market and can earn good returns. So apart from that, any person who is actually earning money, they should invest money for their future needs. Now, first thing first, we need to understand what are our investment goals. Now, once we understand that we have investment goals, like somebody can have an investment goal of, let's say, buying a car, buying a big house after a certain number of years. You are earning because you want to finance your higher education. You want to finance higher education of your children. You can have an investment goal of financing some of your children's marriages, or you can have a post-retirement plan that you want to save money enough that after retirement you don't have to worry about money and you have enough corpus of fund available so that you can save money. So let's start talking about from a student's perspective. A student who's a teenager and who's in class 11, 12, or being a graduate or a postgraduate student who only gets a pocket money. So you can imagine a scenario that 1,000 rupees, if a student can save for certain number of years. Now we can, I would just talk about here in this table that how much returns you can get if you are investing 1,000 rupees. Let's say you have an initial investment of 1,000 rupees, and every month you are ready to spare and save and invest money 1,000 rupees per month for, let's say, next 15 years. Let's say you go to a bank and you save your money in a bank account. So after 15 years, your total investment will be 1,81,000. That will be a total deposit. Assuming that bank give you 4% interest, so 70,695 is the interest you have earned. So in a saving bank account, if every month you deposit 1,000 rupees, your total returns after 15 years will be just 2,51,695 rupees. Now, if this 1,000 rupees, let's say you were intelligent enough that you took a fixed deposit, that 1,000 rupees per month, annually it becomes 12,000 rupees. So let's say 12,000 rupees per month you are investing in a fixed deposit for next 15 years. So the total deposit amount remains the same, 1,81,000, and your total investment, keeping in view what is the current rate of fixed deposit we are getting, we are assuming it is 7%. So the total returns which you will get, your money will become 3,25,416. Now let's say you are smart investor and you understand what are mutual funds and you want to invest money in mutual fund, and somebody suggests you a SIP plan. Now for a period of 15 years, if every month you are having a systematic investment plan and you are saving 1,000 rupees in that systematic investment plan, after 15 years, your total money which you have deposited is 1,81,000, and the amount you will get after 15 years with the average return of mutual fund which we have researched, and everybody says that 12% is the average return which mutual fund industry is giving. So your total returns will be 5,10,572. So approximately it's more than double of what you are getting in a saving bank account. So for 15 years, if you save your money, just look at these figures, 1,000 rupees every month you are saving for 15 years, you just get 2,51,000 at the end of 15 years in a bank account. In a fixed deposit, because a lot of people in India do have a fixed deposit. So if you take up a fixed deposit with a return of 7%, it will just give you 3,25,416 rupees after 15 years. But the same 1,000 rupees, if invested in a mutual fund which gives an average return of 12%, your money becomes 5,10,000. You can buy a car with that money. Now let's say you are a risky investor and you want to try your hands in the stock market, and every month you start saving 1,000 rupees to invest in the stock market. How much this money will become? After 15 years, this money will become 6,86,219. Now you can compare the saving bank account rate of 2,51,000 with a rate of 6,86,000, just 3 times the returns. Assuming that stock market on an average in 15 years is giving you a return of 15%. Your money in a fixed deposit, you just get 3,25,416, which becomes 6,86,000 in 15 years time. So that is the compounding effect of investment in the stock market. Now there can be a question for all those who are working, that at the end of my retirement, I have an assumption, I just wish that I am left with 1 crore of rupees. Now at the end of your, let's say at the time of your retirement at 60 years of age, whatever is your age, you are 25 or 35, whatever is your age group, and you want to have 1 crore at the end of your retirement apart from all other savings and investments you have. So if let's say your current age is 30 plus and you start saving and investing money in the stock market today, and let's say you just invest 1,000 rupees per month. So if you start investing 1,000 rupees per month for next 33 years, at the time of your retirement, assuming that the return you are getting in the stock market is 15%, you will get 1 crore 11,45,554 rupees. So that means at the end of your productive life cycle, that's 60 years of age, once you are attaining the retirement age, so you will have 1 crore rupees just by saving 1,000 rupees. So it is just a financial habit. So if you just start saving 1,000 rupees per month for next 33 years and putting it in right kind of stocks in the stock market, you can earn up to 1 crore rupees. How much you have invested over these 33 years if 1,000 rupees is being invested? You just see it is just 3,97,000 rupees. So approximately 4 lakh rupees you will save in your the amount you will invest in the stock market, and rest 1 crore 7 lakh rupees will be the interest the amount will be earning. See the magnifying effect of just having a financial habit of investing 1,000 rupees per month in the stock market if you are a risk taker. Let's say you want to take risk, but you don't want to take very high risk, so you can go for mutual fund investment. Assuming that mutual fund investment where you don't have to work too hard to watch the market, you just have to save your money in a systematic investment plan. You have to take up a systematic investment plan and just forget about it. And after 39 years, if every month you have a saving investment habit of having a systematic investment plan of 1,000 rupees every month, and you will get 1 crore 6,38,971 rupees at the end of 39 years. At the time of your retirement, you will have 1 crore of rupees with you just by having a habit of 1,000 rupees of investment. Now some people can have a target that okay, 1 crore is fine. Now I have children for whom I want to plan for today. Now, if your children ages, let's say they are young children, and you assume that after 20 years you will need money for their higher education, or you need money for their marriage after 20 years, and you want to know that how much you should, let's say you would like to take medium risk, how much you should invest in a mutual fund, and you want to take up a risk of, you want to take a medium risk and you want to have 12% returns and by investing in mutual funds, and you want a corpus of 50 lakhs. So if you want 50 lakh rupees after 20 years for your kids' education or the marriage of your kids, how much you should start saving? How much you should start investing in a mutual fund as a systematic investment plan? Maybe a systematic investment plan of 5,000 rupees per month. For 20 years if you invest, you will save a corpus of 50 lakh rupees over 20 years. So your total investment will be just 12 lakh 5,000, and rest all is the interest which you will, the compounded interest which you have earned on that mutual fund, because the rate of return in mutual fund industry is high. Now you can see that how important, how irrelevant that saving of 1,000 rupees for somebody who's earning money, who's saving money. So just making a systematic plan of your investment, just looking at that, 1,000 rupees if you start saving in a stock market or in a mutual fund, as compared to if you're saving the same amount of money in a fixed deposit or in a saving bank account or any other traditional method of investment, you can see how much returns you can get on that money. Now, talking about how and what are the risks involved in investing in financial market. Now, we see that this stock market, financial markets instruments are very lucrative because they offer very good returns, but there are risks involved. So, instruments like equity shares, which are also known as stocks or shares, debentures and derivatives, their prices depends upon various factors, which brings out the riskiness of these instruments. These factors include companies' performance like sales, profit, investment returns, internal management, expenses, etc. There are industry and economy related factors that affect the prices of these stocks and bonds. Boom, recession, inflation rate, interest rate, government policies, GDP growth rate, exchange rate, etc. All of these macroeconomic factors also affect the stock market prices. International markets also affect the performance of Indian financial markets. So whatever is happening in US, UK or any other financial world, Hong Kong stock exchange or Japan economy, all of these now the markets are interconnected so much that any impact in the international market will have an impact on the Indian stock market as well. So talking about the risk can be classified as two types. There can be a systematic risk and unsystematic risk. Systematic risk is caused by the economy related factors. These are macroeconomic issues, international market impact, which are uncontrollable by the company, and they affect every company equally. So nothing much can be done about the systematic risk. We can just time our investment around this period in such a way that we earn profits during such phases of buying and selling securities. Thus, this risk can be managed on the part of investors by understanding the market carefully, knowing what is going on in the economy and the perception it is building about it. Timing of their investment. So one, as an investor, one can time our investment in such a way that they can earn maximum profit at any point of time. Second type of risk is unsystematic risk. It is also known as controllable risk because it is controllable on the part of the company. It is a risk which occurs due to internal business operations related to performance of the company, issues and challenges the company is facing, its market share, how well they are managing their business. Well, successful and healthy companies are able to manage this risk really well. Because this is company specific risk, it is also reflected by the beta of the company with respect to market index. From the point of view of investor, now this risk can be easily managed and reduced by investing in a portfolio of investments. A portfolio investment means when an investor is investing his money in a variety of companies which have different risk profile and are in different lines of business, so that loss of one company can be covered by the profit of others, and overall your investment portfolio gives you an average good amount of return. So never put all your eggs in one basket. That's the rule of portfolio investment. So talking about these two risks, which is the systematic risk and the unsystematic risk. Now systematic risk is uncontrollable. It is market related risk. Now this For an investor, the rule for covering the systematic risk is that your timing of investment should be appropriate. When the market is down, one should enter into the market at that time. So one should keep a watch on the market. Whenever you feel that the price of the share is right, one should enter the market and invest, and whenever the market is high, one can disinvest. So thus you will be able to cover the systematic risk part. And the unsystematic risk, which is controllable by the company, which can be avoided by portfolio investment, by putting your money in various type of instruments. Now we also understand that there is a risk return trade-off. Risk return trade-off is that any instrument with low risk will give low returns. Any instrument with high risk will give potentially high returns, because risk and return, that's the kind of relationship risk and return will have. The risk return trade-off is the trading principle that links high risk with high reward. The appropriate risk return trade-off depends on variety of factors, including an investor's risk tolerance, investor's year to retirement, and potential to replace lost funds. Time also plays an essential role in determining a portfolio with the appropriate level of risk and reward. Now, investors use this risk return trade-off as one of the essential components of each investment decision, as well as to assess their portfolio as a whole. At the portfolio level, risk return trade-off can include assessment of concentration or diversity of holding, and whether the mix present too much risk or lower than desired potential for risk. Talking about the risk return trade-off, now we understand that any investment asset where we will have less risk, the return expected would also be less, and wherever an investor will be taking high risk, the risk expectation and the return expectation will also be more. So depending upon, so that's the kind of relationship risk and return have. So based on one person's risk appetite, one can decide that how much risk he is ready to take, and based on it, how much return he can get. Those who do not want to take any risk, they always go for investment in saving instruments which are provided by a bank or a post office deposit or any other government schemes. And those who are ready to take medium to high risk, they go for investments in mutual funds, exchange traded funds, gold, real estate. And those who are ready to take high risk, they start investing their money in stock market, in the debentures and preference shares and derivative market. Now talking about, all of us understand how to save our money in the bank account. So we'll today talk about that, how to invest your money in the stock market. Now stock market is a market which comes under the capital market. Capital markets help channelize surplus fund from savers to the institutions, which then invest them into productive use. In other words, capital market are venues where savings and investments are channelized between the suppliers who have capital to those who are in need of capital. Capital market consists of primary market and secondary markets. Primary market deals with trade of new issues of stocks and other securities, whereas secondary market deals with the exchange of existing or previously issued securities. In the capital market, both equity and debt instruments like equity shares, preference shares, debentures, zero coupon bonds, secured premium notes and the like are bought and sold, as well as it covers all form of lending and borrowing. What are the functions of capital market? Capital market helps in mobilization of savings to finance long-term investments. It facilitates trading of securities. Minimization of transaction and information cost is possible. It encourages wide range of ownership of productive assets. Quick valuation of financial instruments like shares and debentures is possible. It facilitates transaction settlement as per definite time schedules. Offers insurance against market or price risk through derivative trading. Improvements in the effectiveness of capital allocation with the help of competitive price mechanism is possible. Now, how do capital markets generate funds for companies? Now, companies utilize capital markets to raise money for projects by issuing stocks, shares through IPOs or public issue, bonds and short-term money market securities. Individual investors, they wish to earn interest or dividend on their saving, they can buy shares of companies who are issuing these securities. Now, how do capital markets affect the economic development? Capital market encourages economic growth The various institutions which operate in the capital market give quantities and qualitative direction to the flow of funds and bring rational allocation of resources. They do so by converting financial assets into productive and physical assets. This leads to the development of commerce and industry through private and public sector, thereby inducing economic growth. Capital market plays an important role by contributing to the growth of country's economy. It provides several avenues for investment opportunities that encourage a thrift culture beneficial in increasing country's savings and investment ratios that are essential for rapid industrialization. In order to enhance economic productivity, it encourages the participation of private sector in productive investments by promoting public-private sector partnership. It improves the efficiency of capital allocation through competitive pricing mechanism for better utilization of scarce resources for increased economic growth. It also encourages equity capital investment and infrastructure development while complementing its effort in financing essential socio-economic development through raising long-term project-based capital. It also helps in diffusing stresses on the banking system by matching long-term investments with long-term capital. Now, what is a stock market? Stock market, share market, stock exchange, equity market, all of these terms which we talk about is the aggregation of buyers and sellers. So basically it's a loose network of economic transactions, not a physical facility or a discrete entity of stocks, also known as shares. Nowadays these exchanges exist as the electronic marketplaces. Stocks or shares of a company represent ownership equity in the firm, which gives shareholders voting rights as well as the residual claim on corporate earnings in the form of capital gains and dividends. The reality is that investing in stock market carries risk, but when approached in a disciplined manner, it is one of the most efficient ways to build up one's net worth. It accounts for most of net worth of average individual. Most of the affluent and very rich people generally have majority of their wealth invested in the stocks. Now, in layman terms, if I try to explain you what stock market is all about, it's as we understand that there are company form of organizations which exist who are doing business like manufacturing or some kind of consultancy or a service sector or any kind of any concern which is registered as a company. When they need capital for investment, they have their promoters who have invested the money. Then there are institutional investors who have lent them money as a owner, as an investor, or they have borrowed money from bank or other financial institutions. Later on, these companies, when they need more money for expansion of their business, they can borrow money or they can get it from owners. And when they have additional requirement of funding, they can go for a public issue also. Going for a public issue means that they can issue shares to general public in the form of an IPO. So when a company issues equity shares which are to be subscribed by general public, that means that a company has gone for a public issue or has launched an IPO. Or when a company can also borrow money from general public by issuing debentures. That's one way of how companies borrow money from general public. Now, every equity share has a face value, par value, premium, IPO price and a listing price. So when a company decides that they want to go public, they want to have general public to become their owners and investors in the shareholding of the company. So they issue equity shares or they would launch a IPO. Nowadays these IPOs are launched by a book building process. Now, book building process is that a company has announced that it is issuing shares by way of prospectus. A company will announce that we are issuing shares, we are coming up with a public issue, and the issue is a book built issue. So they will give a price range, a lower range and a higher range. Within that price range, the investor will decide that what is the right price for this share, and they would send their application money. If their application money gets selected and shares are allotted to them, they will become the owner of the company. As an equity shareholder, they will get voting rights in the company. That means they can participate in the annual general meeting whenever some decisions are to be taken, and they can cast their vote related to those decisions. They get the right to appoint the management of the company who are going to take decisions on behalf of those shareholders. So the price which is defined, after that, once the issue closes, the shares are listed on the stock exchange, and then those shares become a part of the secondary market, that is the capital market or the stock market, and then anybody can buy and sell those shares whenever you want to buy those shares again, or you want to sell those shares and liquidate your position. So this process can be done. Let me just take one example here about a recent IPO that has come. It is about Neogen Chemicals Limited. So this Neogen Chemicals Limited public IPO came on 24th of April 2019. That was the issue open date. So an advertisement came in the newspaper where they had talked about that we are this in this company and we are going to issue shares. Anybody who is ready, who wants to be a part of the investors, they should send an application money in the proper format. The issue close date was 26th of April. Listing date when these shares were listed on the stock exchange was 8th of May. Now each share has a face value. I was talking about that each equity share has a face value. That means what is the worth of that share at the end of the when the company will liquidate, or when the company will want to close down its business, what is the worth of the share? So the face value is the par value of the share at which it will be listed in the books of accounts of the company. So the face value usually for all companies' share is rupees 10, or rupee 1 or 100 can also be there. Now these most of these companies who are good enough, they are existing businesses and they have a good goodwill. So they have a premium price which they offer at the time of launch of their shares, at the time of issue of these shares. So the offer price which was quoted by the company of Neogen Chemicals Limited was the price range between 212 rupees to 215 rupees. That means 10 rupees is the face value. Offer price is in the price band of 212 and 215. How much is the premium? 215 minus 10. So 205 rupees is the premium price for the share. Now this, for the accounting students, they need to understand this share premium will go to the reserves and surpluses of the company, and it is the amount of premium which the company has got for a share which was rupees worth 10, but people are ready to pay 215 rupees for that share. And what was the size of this issue? So we can see here that the size of the issue was 21,54,535 shares were issued by the company. Now after on 8th of May, the shares got listed on the stock exchange, and on the date of listing, the opening price at which the share was launched on the stock exchange was 251. So those people who had purchased this initial public offer of Neogen Chemicals Limited, who had invested their money on 26th of April 2019 and they were allotted shares, you can imagine that they have made a profit on the date just after 15 days, on 8th of May when the shares were launched in the stock exchange. They could make a profit of 251 minus 215 rupees, and on the same day the closing price was 264. Now let me talk about another public issue. Last year there was an IPO of Bandhan Bank Limited which came. Now this Bandhan Bank IPO was launched on the issue opening date was 15th of March 2018 and the closing date was 19th of March 2018. The date on which it was listed on the stock exchange was 27th of March. Again, the face value of the share was rupees 10. So whatever is the difference between the issue price and the face value goes to the premium account. The offer price range, because it was a book building process, was given as 370 to 375. So the investors were allowed to choose any price between 370 to 375. The share was oversubscribed and was launched at 375. So 375 minus 10, that means 365 rupees per share was the amount of premium which the company has earned. On the date it was listed on the stock exchange, that is on 27th of March 2018, it was launched on the stock exchange at the price of 499. So from 375 to 499, within 15 days, everybody who had invested and who were allotted those shares, they could earn a profit of more than 115 rupees on that share. But the closing price on the same day for that company was 477. So every day there can be up and down of the prices of a share. Now somebody who possessed the Bandhan Bank share, as of today the price of Bandhan Bank share is 535 rupees and 85 paise. So you can imagine how much can be the capital gain when you are investing money in the stock market if you have purchased the right kind of shares. Now these were some terms which I wanted to explain to you. Now talking about a term called market capitalization. Very commonly when we talk about stock market, or when you read about stock market, you will read this term market capitalization. What does market capitalization means? Market capitalization is calculated as how many number of shares are existing for that company. As we talked about in Bandhan Bank, that they have issued 21,54,535 shares. So if that is the total number of shares that company has, so those will be the number of shares multiply with the share price. So if the share price is 264, so 264 multiplied with 21 lakhs of shares which they have, so that is the market capitalization of the company. So that's how the company decides that how big is the size of the company, and that's how it is compared with other companies in the stock exchange. So in stock exchange, the companies are classified as high cap companies, mid cap companies, and small cap companies. And we also use the term blue chip companies, which are growth companies or which are performing really well. So market capitalization is a very simple term, which is share price. That means the current share price of the company multiplied with the number of shares. Now, while talking about that, which companies' shares will be a part of the index, that means the Nifty and the stock, the Sensex we are talking about. So it is also based on the market capitalization. So we calculate free float market capitalization. Another term which is again very popularly used, free float market capitalization basically is market capitalization. That means those number of shares which are existing for the company. Let's say a company has got 50 lakh of shares. Now out of those 50 lakh of shares, let's say 10 lakhs are held by promoters. Promoters are those people who start the company, who are the initial shareholders in the company. Now they are those people who are the people who are passionate about the company, who have started the business. They do not want to sell the shares. So that means those shares are actually blocked with them. They will never go in the stock market and sell their share. So we do not expect Mukesh Ambani or Anil Ambani selling the share of their companies, because they want to possess it. Somebody who has got good number of percentage of shares in the company will have more say in the company, because each share carries a voting right. So that's why those who are possessing the shares, they have a significant amount of shares and they do not want to lose their ownership in the company. Those people do not sell the shares. So that means those shares are not freely floating or freely available in the market for buying and selling. So they are deducted for calculating free float. Second type of shares are those which are held by the government. Now there can be investment of government in some companies. Especially for public sector companies, the investment of the government is huge, but for other companies as well, government can have some stake in the company. Now, if government is having, let's say, 5% of or 10% of shares of any company, the government also usually will not sell every day. Government doesn't participate in the active market. So that's why those shares are also not freely floating in the market. Then there are shares of big financial institutions. Those shares which are purchased by big investors or big financial institutions who want to have a stake in the company, they also do not sell those shares. So free float shares means those shares which are freely available in the market for buying and selling for general public purposes. So that is why we take the market capitalization for the purpose of calculation of being that any share will be a part of the index calculation or not. We take the free float market capitalization. So those shares which are freely floating in the market, only they are considered while calculating the number of shares which are existing. Now so that means a company which is big, so everybody wants to be a big company in the stock market. So a company which is popular, which is big, that means they have high market capitalization. They are growing, that means they have high market capitalization. Now number of shares a company cannot change every day. Now what is changing in market capitalization? Why market capitalization can be calculated at any point of day in the time, and it can vary because there is a variable part in this formula of market capitalization is equal to share price multiplied with number of shares. Now number of shares remain the same for the company for most of the time. Share price changes. Now what leads to the changes in the share prices? Now the share price, as we just now we have seen that the day Bandhan Bank was listed, it was listed at 499 and the closing price was 477. So you can see that within the day there is a price fluctuation, which is known as the volatility of the market. Now why do share prices change during the day? This is on the basic principle of market, that is based on the demand and supply. Any share will fluctuate throughout the day. That's what is the mechanism of the stock market, that all the shares are allowed to have a fair play of demand and supply. There are buyers in the market and there are sellers in the market. So as investors, as we people, as general investors, as retail investors, and then there are big players also in the market who can anytime buy a share and sell the share during the market timings. So during that market timings, we can have a demat account and we can start buying and selling the share. So somebody who will demand for the shares, who would like to buy. So at any point of time, if the number of buyers who want to buy a particular share are more than the number of sellers who are available for that share, so basic principle of demand and supply which applies, that prices will go up. If a share is demanded more as compared to its supply at any point of time, the price will go up. But if the sellers are more, there are more people who want to sell that particular share on a particular day as compared to the number of people who are ready to buy that share at that point of time, the prices will start falling. That's the basic mechanism which works throughout the day in the stock market, and that's what leads to the volatility in the stock market. Now why do people want to buy a particular share and why do people want to sell a particular share? So we can have a good discussion about it. Every investor has a perception about a company. Every day in the newspaper, in news channels, we read about that, these are the decisions which are taken by a company. Or the company, let's say, Anil Ambani recently has filed for bankruptcy. Jet Airways is going through a bad phase. So when any negative news comes about a company, as an investor, would I like to buy a share of that company? No. As a general investor, I do not want to, or anybody would not like to buy a share of a company which do not have a good prospect, which is not giving a good picture in the market, which do not have a growth prospect, because as an investor, everybody wants to make their money multiply. So looking at the psychology of the investor, we have to see that a share will be demanded more, or there will be more number of people who would like to buy that share if that share is promising, if that company is promising, if the company is doing good work, if the company is having positive news about it. So whenever a positive news comes about a company, people will start buying the share of that company. Or whenever they will hear about a negative news about that company, they will start selling the share. Now this negative news or a positive news which will make the perception of the investors about that company's share on any day at any point of time not only depends upon the company information, something related to the company. It can happen that on some day, one company, there is no news, but then there is a news which is coming from the economy. Let's say when elections were happening. So very recently India went for this elections. So union government elections happened. there was a lot of uncertainty. We were not sure that, whether BJP will win or Congress will win or some other party will win. So it was a phase where there were a lot of uncertainties. So at the time of uncertainty, the volatility of these markets also changes. Do you think that there is a political impact, or let's say impact of any political party which changes on the stock market? Yes, there is. Because the governments, they form the policies for corporate world, for everybody else, for general investors, for banking industry. How will the economy behave depends upon what kind of government we get. So that's why any uncertainty in the government, at the government level, will bring uncertainty in the stock market. Even if shares are doing well, even if companies are doing good, they are earning good profit, but there can be times when markets are bad, when the markets are volatile and people have no faith in anyone and they do not want to buy shares in the stock market, and market starts falling. So if all the people start selling a particular share, and let's say it happens with all the shares of various companies or majority of the companies, we say that a bear phase has come. So bear phase means when a downtrend comes, when there are more number of sellers in the market of various companies' shares, so overall the stock market is going down, it's a bearish phase. And sometimes it is positive news which is coming. For example, if you see that on the date of budget is the union budget which is announced in the month of February, is a very important event for all of us. Everybody is hooked onto TV and internet and they want to know that what is happening in the budget, what kind of announcements government is making related to the budget. So whenever a positive announcement related to a particular sector, let's say automobile sector or infrastructure or any other sector comes, so it brings in a positive picture and people start buying the shares because they feel that it's a positive news. This will boost this particular industry, and people start buying IT shares or start buying automobile shares or some other shares. Then this phase is known as the bull phase which has come. So bull rises so what is a bull market? A bull rises its head above when it is in attack mode, where a bear moves its head downward while it attacks. A bull market signifies optimism, positivity, and reflects investor confidence in the market. People have a sentiment that prices would go up. The market can be in the bull phase where the economy is strong, the prices of all stocks move up, and people tend to become bullish on all stocks. As the bull market continues, it is sure to breed greediness in the stock market. Investors start buying more shares as they are optimistic about their performance. Bear market, basically it happens when unemployment increases and there is a slowdown in the economy. In this scenario, fear grips the investors and investors start selling their stocks as they feel that the price of stocks are poised to go down. The markets associate bear market with a recession. So basically, when you're investing your money in the stock market, your money grows in three ways. One, if you are an investor, if you are an equity shareholder in the company, you will earn dividend at the end of the year because you will get profits, the company will earn profit, and that profit gets distributed to each and every shareholder who exists. So you will get dividend returns. Then any time in the market when you feel that the price at which you purchase the share and the price at which it exists trading at any point of time, if there is a uptrend in that difference, so and you sell that share on any day, then you will get capital gain. And third kind of returns you can get is the buyback. So buyback is when the company is trying to buy back the shares, so it will never buy it back at the price at which you invested in it. They will give you a lucrative price so that they can buy back those shares from you. So that's how you earn your returns in the stock market. Now this is all for today, and we'll continue with this discussion on how to invest in the stock market in the lecture next week.